Okay, thanks, Greg. Now, this is part two or an extension of what we talked about last week. The title is Low-Cost Strategies to Build the Resilience of Beef Production Systems in Northern Australia. But when we work our way through this, you'll find that there's probably some hidden costs in amongst these strategies that we've got to consider as well. So just to acknowledge that this work is heavily contributed to by Trudy Oxley of the Department of Primary Industries in the Northern Territory and Marie Bowen from Rockhampton DAF office. Without their help, this wouldn't be happening because they have the knowledge and skills to help the economist with these problems. The work has been funded by the Northern Territory Government, by the Queensland Government, and the ongoing funding for this work is through the Drought and Climate Adaptation Program. Thanks. Okay, so just to revisit a little bit of what we did last week, which was about improving the performance of beef production systems in Northern Australia. And the two questions we asked, the first one was, what are the strategies most likely to improve the profit and resilience? And we looked at a lot of strategies, and it was obvious that you can't look at all the strategies. So the second part was, how can you assess alternative strategies as they come up? Now, we then said, okay, to assess these alternative strategies, there's one way of doing it. The best way is to estimate the change in profit, because profit is a measure of efficiency, and what you want is a more efficient or profitable beef production system. So that's where we got to in the first part of this webinar series. This part two considers low-cost strategies focused more on optimising the current production system than making a significant change to the production target. So slightly different focus, but it's the same sort of things. Just to go back and summarise the findings of what we found in that part one webinar, it was really came out that across Northern Australia, across our beef production systems, one of the really important things to take account of is the P status of the herd. There are a lot of herds that have are working on P deficient country. So working out the P status of the herd and then addressing that deficiency is a very high priority, and probably the first priority for a lot of people in the north. The second thing that came out of the first webinar was that when you build models of beef herds and production systems across these northern regions, the median rates of mortality that were found in some of the survey data are critical. They really drive a lot of the performance of these herds. And those critical mortality rates, if you are sitting about the median mortality rate, it needs to be addressed with a whole of property strategy. You can't look at bits of it, you've got to look at the whole. Then coming back to the next priority, we thought that future investment for beef producers in perennial legumes was key in a lot of regions. Then we thought, okay, what's left? And we worked out that targeting the performance of the breed herd in isolation was not really an investment, but it was more of a prerequisite. So we had to come up with low-cost strategies, because putting a lot of cost into the breeder herd didn't pay in any of our strategies that we looked at in part one. So what we've done is say, okay, in this part two, we'll go on and look at some of these low-cost strategies to aid resilience. And the things we want to look at are the body condition of the breeders, the sort of herd structure, and how that affects the performance of the beef herd. And the things within the herd structure we're going to look at are like female cull age, and this affects the profit and the resilience of the herd. Because we're looking at the impact of drought on these herds, resilience, building resilience into these herds is critical. And also in that herd structure thing, the age of steer turnoff is also an important thing to consider. And this will affect the number of breeders in the herd, which can affect your drought resilience, can also affect your profitability. So that's what we're on about today. To recap, that we used data from 3 regional property models that we've built across the north, and these results that were presented today are also based on those 3 regional models of different sizes based on different locations. And the data we used from those in those models, we worked with about 30 property owners and managers across Northern Australia over recent years to look at their properties and their options and compile case studies about how they thought the future looked for them. Then we went ahead with the people who work in the industry in this area and the RD&E staff that we worked with, and we identified the key technologies that we thought would make a difference and how that could be combined in these representative median models and look at the expected returns. So when we wanted to build a response into these models of how we think changing things might operate, we went to any research data we could get and built the responses out of those. So we used cash cow project data to look at the reproduction efficiency of herd. We used the mortality data from the determining property level rates of breeder cow mortality in Northern Australia to build the mortality rates. The high output forages project we used in the Fitzroy to look at what happens when you introduce forages into these systems. And when we were looking at the impact of phosphorus, one of the important projects we were looking at, which is currently underway in the Northern Territory, was a phosphorus supplementation of Brahman heifers in phosphorus deficient country, which is a really important and interesting project. And then any other information that we get from any source we also use. So, low-cost strategies of aid resilience. Now, the first one is managing breeder condition. And as we said in the previous webinar, this is not an investment, this is a prerequisite. And when you're thinking about breeder condition, what you're normally presented with is pictures of cows showing body condition scores. So you can get an understanding of a cow that's in body condition 1 will look like this, and we expect certain outcomes if she's in that body condition. A body condition 2 will look like this, and we expect certain outcomes. Now, the trouble for the economist and the modeler is, how do you put a picture of a cow into an economic model? And there's been some really good work done by David Mayer and a few other people on how do we organise a description of whether a cow is poor, backward, moderate, or forward or fat, so that we can say, okay, if a cow is poor, what does that mean for her future? Now, David has done a fairly significant amount of research into what affects mortality across the north. He analysed the data from 17,100 cow years from 6 sites across Northern Australia. It was cohort level data, so it was regionally specific, herd specific. And out of that analysis, he found that mortality could be predicted with this formula. And in that formula, there was a body condition ratio a number of times, there was the age of the cow and the weight change of the cow. So when we say, if you say a cow in forward store condition, what's likely to be her outcomes in the future if her weight changes and at her age, what's her risk of mortality? Well, we can use this formula. It's quite a complex one, but when you break it down, it's all about what's the starting body condition of your cow, what's going to be her weight change, what's her age. Given those factors, we can predict their mortality. Now, why did we pick mortality here and not reproduction efficiency? Now, reproduction efficiency and mortality, when we looked at them in our models, the median rates of mortality, getting them right and reducing them across the north is economically significantly more important to outcomes than reproduction efficiency. It's important, but when you look at what can we do to really change these systems, high rates of mortality and the median rates of mortality that are retained are critically important. So that's why we're looking at mortality. Now, all these things swing around a standard reference rate, and the weight change from that standard reference rate will affect what we call a body condition ratio for that cow. Now, this body condition ratio goes in this formula, and then we use that to predict mortality outcomes or risk of mortality. So let's look at an example of that. Let's look at the predicted rate of mortality by class of female stock using that formula. If they start the dry season with a moderate body condition score, which is either 3 or 5, depending on which scale you want. So a 3 is moderate or a 5 is forward stored, but they're about the middle of the picture. So if we start with about that moderate area, and you can see here we've got a table where we've calculated the risk of mortality in the next period based on the age of the cow or the class of the cow and the weight loss in that next period. And you can see a little bit of weight loss for a moderate cow has a mortality risk that increases with age. A big weight loss, a crash over that period, has a very high risk of mortality, or a higher risk of mortality. So you can see mortality risk increases with weight loss and age. Now, what happens if we don't quite get that? And now starting with a moderate BCS is not the recommended starting point, but it's just where we looked at for this model. Let's say you get it wrong and you start with cows in a store condition, which is a slightly lower body condition score of 2.5 or 4, so a slight difference. And then they suffer a weight loss. Now you can see the mortality rates suddenly explode, and that there's a very high risk of high rates of mortality if you get it wrong and your cows start the dry season in a store BCS and then lose a significant amount of weight. So this is the risk that we've got to think about when we're looking at the economics of improving the performance of these systems and building resilience into them. Now, unfortunately, mortality risk is often episodic. So it's related to episodes in the climate or the weather pattern that lead to these weight losses or massive weight losses. And it's normally related to drought. Now, here we've got a graph or a diagram or a picture that shows the rate of mortality predicted for the years 1985 to 2014, using that formula that was developed by David and his co-workers to express the mortality risk in different years. Now, this was based on Mitchellgrass country at Longreach, and some of these rates are a little bit overstated because this is an early version of what we've done. Some of these numbers come down a little bit when you put a better managed herd in the model, but you can see that, again, each one of these bars is for a different age group of cows. And if we zoom in here on the drought of the 92, 93, 94 and look at that, you can see that the risk of mortality or the rate of mortality is related. See, here's from weaner heifers upwards, and some of these are a little bit overstated, but the distribution is about the same. And you can see it significantly increases with the age of cows. And the older cows in the herd have a much higher mortality risk. So what does that mean for our economics? So we've got a herd structure in the Fitzroy, and we developed that herd structure and that herd model from cash cow data values. And when you put long-term prices and cash cow data values into a model and optimize it, you come up with an optimum cull age of about 12 to 13 years of age, because that's the way the prices of the heifers and the performance of the older cows trades off when you use the cash cow data. Now, underlying that data is this knowledge of the mortality risk. And we ask ourselves a question, even though cash cow says we can probably keep cows to an older age, and this is this table shows the ages of the cows in the model, and that you can look at how many you've got at the start of the year on average in this model in each age group, so 1 to 13 years old, and then how many cows will be mated in each group and how many cows retained in each group for the year. So these are the ones that are retained going into the dry season to produce a calf. So these are the ones that are at the highest risk. And there's a fair number of them there in this Fitzroy herd, and they contribute a fair number of weaners on average. Now, the question that we can ask is, how much does it cost to get rid of these cows out of your herd? They are an increased risk of mortality in a drought, even though the average model doesn't show it. So what's it cost us to get rid of those out of the herd? So we can reformat this model. Here is our base herd with a 13-year cull age, and we can look at the parameters of that herd with a 13-year cull age, and we come up with a gross margin after imputed interest. And then we can rebuild that model and reset it so it culls everything after 9 years of age. And in the Fitzroy, you can see that a lot of these parameters don't change very much, and there's a negligible impact on profit of removing those older cows out of this herd, even when the optimum, it's only a few $100s, and the model tells you to 10 decimal points what the answer is. But when you look at it and you think about the other risks in having old cows in the herd, you can see it doesn't cost you anything in the Fitzroy to get rid of them. Now, we did a similar exercise for the North Queensland Gulf, which is a completely different system, where we looked at reducing the maximum cull age of the cows that had a lower level of reproduction performance, had lower productivity herd. So what happens when we reduce the culling age in the Gulf to get rid of those old cows? You can see this model, if you were with us last week, is the model for when we'd improved land condition and we got our phosphorus supplementation right. So this is the end point of our modelling process of looking at options in the Gulf of sorting out our land condition and getting wet season P supplement right. So this is a pretty good performing model, and it was a lot better than where we started in the Gulf. So what happens when we reduce our cull age on these cows? And when we optimise it to everything's culled, last mating's 8 to 9 years, you can see the profitability of the herd actually improves by about $7,000 a year. Now, what's going on here? Now, what's going on is that when we calculated the effective P supplementation land condition benefits, we didn't re-optimise the model. Now, the reason we did not re-optimise the model was in the original analysis, we wanted to keep the cow culling age the same in both scenarios, so we didn't upset the analysis of marginal benefit. But in reality, these benefits of once you've got your herd in the Gulf sorted out and you've got the right amount of P, you've got the best growth rates you can get under those conditions in that system, you can get rid of those old cows, even in herds where the reproduction efficiency is not that great. Now, another thing that we looked at was heifer culling strategy in these different herds. Here's an example of our process for Katherine, where we looked at what age should we cull our heifers in this Katherine herd. So we'd built the herd and we'd looked at, we'd set it up initially to cull heifers prior to mating. So to do that, we set up our model so that we culled 30% of the 1 to 2 year old heifers before mating. Because of the low reproduction efficiency in this herd, we could only sell 25 of the PTE empties after mating in this herd, and that led to a small number of 2 to 3 year old cows being sold. Now Trudy Oxley said, well, what if we overmate the heifers and sell them after mating? So what we did, we changed the model so that we only took out a few culls out of the 1 to 2 year old before mating. We mated the 2 to 3 year old group and then culled everything that was empty out of that group, and then we had a lot more sales in that age group. So when we built this model and then we changed it to that model, and this is the basic difference between those two models. Shifting that cull age in those heifers added $32,000 to that model. Now, this benefit was achieved even though the younger heifers sell for 24 cents a kilogram live weight more than the 2 to 3 year old PTE and culled heifers. Now, this is an interesting result, but different regions and different properties have different cullings profitable. So even though that culling strategy looked pretty good in the territory, when we've since done this for the Longreach property that we're developing a model for, the 1 to 2 year old heifers came up as the optimum culling age in that system because of the different weight gains at different selling prices. So this answer here, it doesn't say that everybody should do that. It depends on a lot more factors than just that one answer. Another thing that we looked at was this, the age of turn off the steers. So here's a low cost strategy. We don't have to go and really invest anything just to change the age of turn off of steers. And how does that aid resilience? So for our Fitzroy model, we originally selected 27 months and 495 kilos as a suitable age to sell the steers. This is the feed on market. This is what a lot of people were doing that we talked to. So that was where we set our model. Now, when we looked at our growth path, so this is the live weight growth of the steers on buffel graph, and here's birth and weaning and then post-weaning growth periods that we predict on average, and here's the months of age. And we can also pull all the steers out at 18 months old at about 381 kilos. We could also restructure the herd and sell all the steers at 6 months as weaners at about 200 kilos, or we could sell all the steers by retaining all these ones all the way through and then selling as bullocks at 39 months old and 677 kilos. Now, we can build a model for each herd structure and each age of turn off, and look at the difference in herd profitability, just as a quick snapshot of what does it look like at different ages of turn off. So that's what we did, and you can see for the weaner steers, we've maintained this, and all ages of steer turn off, we've maintained the same grazing pressure on the property, but what we've done is change the age of turnoff right through, and then recalculate the new herd structure. So you can see if you're turning off weaners, you've got a lot more breeders mated than if you're turning off 3 to 4 year old steers. You're selling a lot less steers each year than selling weaners, but these are bigger and older. So, and then you can work out the capital value of the herd, the amount of money you've got tied up in cattle, and you can see because you've got a lot more steers in the 3 to 4 year age turnoff, you've got more capital tied up, so you've got to allow for the opportunity cost or what it costs you to hold that extra capital in your calculation. So we can quickly calculate a gross margin after imputed interest for each herd age turnoff, and you can see that allowing for all these factors in the herd restructure and just pretending we could wave a wand and do it overnight, that our base herd that we picked is about the same profitability at long-term prices on buffel grass pastures as a 1 to 2 year old younger steer. There's not a lot of difference there in reality, but turning off big old bullocks reduces the profitability slightly, and focusing on weaner production where everything goes as weaners reduced profitability significantly, which was an interesting outcome. Now, in terms of drought resilience, you've got to notice the number of breeders mated reduces at each age. So going into a drought with less breeders here could be beneficial. Now, when we built these gross margins, we did actually have an allowance per breeder for drought feeding. So as we increased the number of breeders, we did proportionally increase the drought feeding allowance. So these already accommodate a little bit of drought expense, and so these differences have that a bit of that breeder number risk incorporated in it. What decides the optimum age of turnoff? So we looked at all the factors that you could pick to say what makes the optimum age of turnoff the most efficient. So is it the proportion of steer beef production in your output, or is it the price of the different things? So when you're turning off weaner steers, you can see here we've got a bit of a pie graph, and it breaks up the output of the beef off that property into heifer beef, cull cow beef, steer beef, and bull beef. And you can see when you're producing weaners, there's a lot more female beef in the output than there is steer beef. Even though that's a much higher price, there's things going on there between price and the amount of beef output, total beef output of the property. Of course, when you go to an older age of steer turnoff, you produce more steer beef and less of the other categories. Again, it increases with age. And then that's one factor. What about the passengers? So when you're producing weaners, you're retaining a lot more weaner heifers in the paddock, and they're not doing a lot for you until they're mated and produce a calf. And you can see the number of passengers falls with each age of turnoff, or changes with each age of turnoff. So what decides the optimum age of steer turnoff? You need to get the right balance between the prices of each class of cattle, the proportions of those beef in the output, the number of passengers that are in the system, treatment and opportunity costs, the cost of capital tied up in the different herd structures, and the optimum age will be impacted by the steer growth rate as well and the breeder herd reproduction efficiency. You can only identify which age of steer turnoff is going to be appropriate for you by looking at the marginal change in profit for each steer turnoff for your herd or property, because two neighbours with pretty similar systems can have different ages of turnoff depending on these things, how they're happening on their property. Let's extend this by looking at the age of turnoff for steers in the North Queensland Gulf, a system where the steers have got lower growth rates, we've got lower reproduction efficiency, and on average, probably similar, once we've sorted out our phosphorus and our land condition, probably similar mortality rates to our Fitzroy model. So in our base herd model, we split the steers into a lead and a tail, and we sold the lead to the export market, and then the tail about 12 months later to the export market as well. Now, the other options that you can consider here is just bung the whole lot off the property at 18 months old, 306 kilos, get rid of them as weaners at 6 months old and 193 kilos, or let them grow until they're on the pension card at 53 months and 640 kilos. So what age of turnoff looks like the most profitable there? Taking into account all these other factors where we keep the grazing pressure the same, we adjust each herd model to the different age of turnoff, and we account for the different capital tied up in these herd structures, you can see that our base herd, when we turning off these live export steers, was not as profitable as our bullocks. So at the long-term prices, which were basically for the last 10 or so years, bullocks look like more profitable than live export steers when you've got your phosphorus and your land conditions sorted in this region, which is an interesting thing. Now, this relative profitability of weaner production, this one here, this -26 and this one here +19, sets challenges for producers who use this North Queensland Gulf area as a calf factory. So they produce weaners on a breeder property up there and transfer them to somewhere else. It means that you might have to look at the optimisation over 2 or more properties to work out what's the most efficient system to have on each property. So let's have a little bit of a think about this North Queensland calf factory process, where in this catchment west of Cairns that we looked at last web, people run this country. This country is just breeders producing weaners, and they transfer the weaners out to somewhere else. So where these people up here, if they can sort out their phosphorus and their land condition, and they have that better production system up here, there might be a significant opportunity cost in targeting steer weaners. And that opportunity cost is the income or the profit foregone by producing weaners when the most profitable option could be bullocks. And this could be about $45,000 a year at the long-term prices in our herd. So that's the opportunity cost of producing weaners up here. So to cover off on that opportunity cost and to make sure that this system up here is not being robbed by Peter to pay Paul, what should we receive for the weaners to be no worse off than targeting bullocks? So we looked at both the long-term prices and some short-term prices. So this is the prices provided by MLA in their price data databases on their website. So we've compared here the restocker steer price since 2014 up to the grass-fed up to June, start of this month, start of last month. Compared the grass-fed bullock. So you can see there's been a significant difference in those prices over the last 2 or 3 years. So you can look at this long term, but you might also have to look at this short term when you're looking at what price we should receive. So our long-term prices were $2.60 for weaners and $2.20 for bullocks in our basic herd model. It was long term. When we look at the average prices here for the last 3.5 years, you can see the weaners were $2.90 and the bullocks were $2.60 when we convert them all back to averages and typical. So let's consider what price should we receive for weaners to be no worse off if these are the price sets in our model. So to be no worse off, this a calf factory in the North Queensland Gulf would need to receive long term. They would need to value those weaners at the sale yards or the paddock they put them into on the other property at $3.55. That's what they'd have to value them onto that property at. And given that the long-term prices were $2.60, the question's got to be asked, what does that mean? Over the last 3.5 years, they would have to value those weaners at $4.35 at the point of sale or the point of transfer to the other property. So that includes allowance for transport off the property to a Downs property or something like that. But the average price over the last 3.5 years were $2.90 for weaners. So the question here is, if you can go somewhere and buy weaners and land them on your property for about $3, why would you suffer the loss in profitability on this property when the opportunity cost of those weaners is $4.35? So where weaner steers are being transferred to another property to grow out of fatten, it may be better to purchase weaner steers for that property than to supply them from the calf factory, especially when you've sorted out the issues in this region, you've got your phosphorus and your land condition right, you might be better off doing something other than producing weaners. There's a problem in this. This is all steady state modelling, but when we go back and look at changing the steer age of turnoff as an investment, it means there's time to take into account and there's money to be foregone or gained by changing the age. It doesn't happen overnight. So in the North Queensland Gulf, we looked at steers that are 1 year older, producing steers that are 1 year older. And we found, if you remember from the webinar last week, that added about $17,000 a year on average to the profit of the business. And it was one of the better things we could do in terms of strategies. But there's a peak deficit of $125,000 that you don't get back to where you would have been until year 3. Now, the modelled property for the North Queensland Gulf cannot survive that peak deficit. So there's a real problem in shifting to an older age of steer turnoff. Now, this deficit that we've got here is going from our export steers to our 1 year older. If we go from weaners, do the same sums from weaners to heavy steers, that deficit's going to be significantly larger and impossible for most of these properties to overcome. So there's an issue there that's got to be dealt with. So even though it is more profitable in the long term to get the age of steer turn off about right, on average over the next 30 years, it's going to be more profitable to do that. There is a significant deficit to be encountered during any changeover period. And this, we used to call it the store trap, but I'm now starting to call it the weaner trap. And it's been around for a long time, and it's one of the main issues in this peak deficit is one of the main issues in getting your age of turn off right in steers in these systems. The adjustment question, this is what we posed last week, was why were steers sent to the floodplains and Katherine on adjustment versus steers sent to the downs in the North Queensland Gulf have a different result? One was positive, one was negative. Now, the positive one was Katherine. 80% of those steers were sent to the floodplains at their normal sale age, so there was no real impact on herd structure. The North Queensland Gulf steers were sent as weaners. This led to the retention of females to build up herd numbers on the home property, reduced the relative profitability of the property because it was now a weaner steer producer, reduced the overall investment returns through though the weaner steer adjustment exercise was positive. So when you looked at, let's send the weaners to the downs and put some weight on them and sell them, that's a positive gross margin. But when you look at it in the big picture, things change. So this just reinforces the need to do the analysis at the property level or the multi-property level and identify the opportunity costs associated with steer sale age targets. Let's look at Katherine. We had a bit of a think about steer sale age in the Katherine region. Different, it wasn't about age of turn off, it was about this problem that they've got up there with these. They used to have pretty tight sale weight parameters when we were doing this exercise. There was a difficulty of moving steers during the wet season for a lot of people, and there were price premiums for younger steers. This led many steers to being sold at light weights at the end of the first wet season. So they were weaned, held a dry season, went through a wet, and then they were gone. So, and they normally came out at pretty light weights, the lead of the steers. So we thought about, okay, how much less could you receive for steers in cents a kilogram live to be no worse off than if they were held for another wet season? So we looked at our optimum herd, developed our gross margin after imputed interest. We looked at selling them 12 months later and losing 10 cents a kilo on our price on average. Still a little bit of profit in that. If we lost 20 cents a kilo at 12 months older, we were behind significantly. If we got the same price 12 months older as we got in our optimised herd for our steers, we were $50,000 a year ahead. Now, we did this exercise when the Indonesian market was very strong, and we didn't think this was a possibility because there was a big drop off in price. But now that market and those weight prices are changing, this 12-month older option, it might be something that people up there start to think about. Now, this question about the profit centre, we say the profit centre is always the steers, and we do things like breaking our herd up into the gross margin after interest for the whole herd, for the breeders only, and for the steer ages. And you can see the gross margin for steers is always going to be a lot better than for just the breeders only. So we say, okay, the profit is coming from the steers, but the profit centre is always the steers, but calculating this average gross margin for components of the herd does not reveal anything about where the next investment should be made. It doesn't tell you whether you should invest in steers or breeders. So the only way that you can work out where your next investment should be made is to look at the margin return on extra capital. That indicates the relative value of alternative investments. So it's better not to guess where the next improvement is coming from by looking at these average gross margins, but to assess all the options on their merit within the context of your production system. So these averages don't tell you anything. It's the marginal value of change that is important. And for you, in your system, the next best investment you could make could be in the breeder herd. Insights. What did we sort of come up with in terms of understanding when we had followed this exercise? So in terms of maintaining breeder body condition, the key strategies we found was, first of all, it's about grazing land management. You've got to get your grass management right. That's the best way to look after body condition in breeders, and it's critical that that is addressed. The second one was an appropriate weaning strategy. Get that right. Together with this, you're making big progress on body condition. Then, for those systems that have a very seasonal flow of nutrition, this appropriate timing of calving fitting in with an appropriate weaning strategy was the next key strategy that we could put into place. And that could be coupled with segregation of breeders in the north where there's continuous mating. Supplements, we felt that once we had our phosphorus supplements, weaning and land management sorted, once we had these things well sorted out, it's difficult to identify an economic return for additional regular supplements. That's in most regions, but in parts of the Northern Forest, that more difficult country across the north, we think there's an exception there, and it's related to protecting the breeding herd from those crashes in body conditions that lead to high mortality rates. So we can't easily do the economics of that, but we think it's there. And the final point here is never replace grass with purchase feed. That's a no-no. Other insights? This about female cull age. It affects herd profit and herd resilience in quite a big way. And this risk of these old cows dying in a suddenly developing situation is a very big risk, and it's important to try and target no old cows in these herds. And the heifer cull age, we can think about that, but it takes a little bit more thinking about prices, growth rates, reproduction efficiency, and risks at different ages to work out the heifer cull age. Age of steer turnoff, you can see that has significant impacts, but it's very difficult to change once you've set one up, unless you're already in bullocks. So the point about these things here is that the management strategies aimed at building resilience can be low in direct costs. So that was our point about low cost, but there's substantial opportunity costs in some of these changes. So you've got to think about them as well, because they're quite often hidden from view. Therefore, the focus continues to be on identifying the relative efficiency or the profitability of alternative production systems, and the decision framework that you apply must always still account for opportunity costs, the time value of money, how long it takes to convert from a steer age of turnoff to another, what impact that has on your finances, your cash flow, what impact that has on your economic efficiency, your long-term profit, and incorporated in all that has got to be the goals of the manager, because they're critical. The framework, all these analyses, all these outputs were compiled in the Brico Dynamo suite of programs. It's free to download off the DAF Queensland website. The project that all this work is being done under is called Delivering Integrated Production and Economic Knowledge and Skills to Improve Drought Management Outcomes for Grazing Enterprises. It's a DCAP project. It's being led by Dr. Marie Bowen in Rockhampton. So all this stuff's coming out of that, and it's funded, as I said, through DCAP. So we looked at three regions, results of three regions. We hope to do a little, we're working on the Mitchell grass at the moment. We hope to cover off on the Mitchell grass Northern Downs. We think we'll get to the goldfields. We've got a target of doing one in the Southern Brigalow, and we've been asked to look at the sheep production systems and cattle production systems in the Mulgaland. So we've got a fair way to go with this project, and there'll be a lot of more outputs popping up. The sample of the sort of outputs, we've got one document that's being reviewed at the moment called Fitzroy Beef Production Systems, Preparing for, Responding to and Recovering from Drought. So most of this webinar 1 and 2 have been about preparing for drought, but in these documents you'll find a lot about responding and recovering from drought. As I say, this one should come up on the DCAP website in the near future because it's being reviewed at the moment. We've got another one under construction for the North Queensland beef production systems. Same sort of thing, but a report focused on the North Queensland Gulf. So look out for them in the future. And that's it. Thanks, Greg. I'll take questions.